Let's talk about SPACs a little bit because, Mark, I've got you on specifically. You've got a SPAC ETF coming this week. I think it's the third one. This is actively managed now. We talked on the air about this a little, but what impresses me about this is 2/3 of the companies will come that you're picking will come from companies that have already chosen a partner, 1/3 from companies that are still seeking startups. What's amazing to me is how you make the decision on active management in this kind of environment and picking a company that hasn't even done a target yet. How would you even decide that? Tell us about this, how you're picking this.
Yeah, look, at the end of the day, it's about the people, Bob. People and management teams, the great ones tend to win. And so, the nice thing is ourselves and Exos, our partner, we've been doing this collectively for 5 decades. We've been partnering with management teams. We've been picking the winners from the losers. And I think the big opportunity here is to take this superior structure, which is if you're a high growth company of the future, right? A company that has really big upside and doesn't want the hassle of the traditional IPO process, doesn't want to be encumbered by not having the ability to make forward-looking statements. You have this wonderful innovation in SPAC structure that allows these companies to get public. And therefore, the great management teams, the ones that you want to partner with for decades to come, become pretty readily available for investors and pretty apparent to professional investors like ourselves. So we're excited to bring this active approach to a market that I think is really in its infancy. I mean, I said, when we were talking last week that 2020 probably goes down as the year of the SPAC, right? More SPACs were issued, more dollars were raised. And there are those that want to call it a bubble. But it's not a bubble. I mean, a SPAC is a legal structure. It's like mutual fund or ETF. And the people that criticize SPACs today are the same ones that criticized hedge funds 10 years ago or criticized mutual funds 30 years ago. When lots of people like a structure and people have success utilizing it, other people, may not like that. So we're very excited about the opportunity, very excited about the market. And you bring up the most important point, and we've been talking about it with the craziness of the markets. The average investor has to navigate extreme valuations, extreme attraction of these markets for unsavory types to bring companies public. And by focusing on quality, focusing on the best teams and the best ideas and the best companies, I think you can get great returns.
Yeah. Focus on quality is all well and good, but it's a pretty confusing universe out there. I want to open this up to Ben and Bob's comments, but I want to first run a comment on the explosion in SPACs from former Goldman CEO Lloyd Blankfein. He was on this morning talking about exactly this. Let's run the bite and we'll chat on the other side.
If a few of these go bad or they were overpaid and some people made a lot of money and investors lost money, people are going to say, you achieve the economic equivalence of an IPO, but where was the process and diligence that we all associated with a rigorous IPO diligence process? And that kind of drops out. Now, I'm not saying that they're all bad or that any of the ones that you could bring up are bad. Some of these won't work. And my advice to people who are doing this now would be really, really diligence, really, really document. But, again, in hindsight, if something goes bad down the road, people will look back and, show trials to follow.
Yeah, exactly. So, Ben, let me get your take on this. We're going to now have 3 SPAC ETFs out there, but I think the relevant line here from Lloyd is we have the economic equivalence of an IPO, but where was the process and the due diligence that we see with a rigorous IPO process? Is that a fair comment from Lloyd Blankfein about the whole SPAC explosion?
Yeah, I think it's a fair comment, and I would argue that it's more so a functional equivalent of an IPO from an issuer's point of view. From an economic point of view and in the investor's point of view, most importantly, I think it's an IPO that effectively shifts more of the risk and potentially less of the return onto investors, that investors in this case, in the majority of these cases, will be the ones that wind up being the bag holders. Looking at research produced off the desks of my colleagues at PitchBook, they see this as a fleeting phase, as a means of raising capital that speaks to the moment that we're in and the difficulty that a lot of these firms would have going through the traditional IPO process. They expect that it'll come and go. And if you look at really the economic equivalent in terms of stocks that are already out there on the marketplace, be they stocks that came to market through the IPO or stocks that are simply smaller and have greater growth prospects, I look back at the performance of the oldest SPAC ETF, SPAK is the ticker there, which has only got a few months worth of track record under its belt. And its performance has been half that of the Vanguard Small Cap Growth ETF over the course of the past few months. And it's been half that of the First Trust U.S. Equity Opportunities ETF, which invests in traditional IPOs. FPX is the ticker there. So investors have to ask themselves whether it makes sense to arbitrarily limit their investment opportunity set to a handful of names that are coming to the market through a very novel means, and one, again, that probably is disfavorable from an investor's point of view, because there's a lot of value that accrues to the end investor through that normal IPO process, a very thorough vetting by many pairs of very well-trained, very detail-oriented eyeballs that are going to try to assess how much that thing's going to actually be worth at the end of the day.
Bob, can I jump in?
No, we put up. Go right ahead. Go ahead. Is that
Bob?
Is that Bob?
It's Mark. I just want to vehemently disagree there. What's interesting is a SPAC IPO is an IPO. It has been vetted. It is even taken public by many of the same firms that Mr. Blankfein refers to. It's typical commentary from an incumbent, right? SPACs took up over a quarter of IPOs last year. That means less business for the incumbent, so it's not shocking that they would criticize. The idea that this is bad for investors is simply not true. The average IPO, the average investor can't participate. Those IPO shares are allocated to the big fat cat clients of the big Wall Street brokerage firms, not to the average investor. A SPAC IPO, because it goes public at a $10 price, is available to everybody. And since you don't know what the deal is going to be, you don't have the speculative frenzy on the day one of trading. So you can actually acquire a position. Then when the deal's announced, again, by quality management teams of quality growth businesses, you've seen outstanding performance. So the last couple of months, not really relevant in performance terms. Look over the last year. Look at a basket of SPACs, more than double the return of the S&P. It's a fantastic structure. It's changed over the last 30 years. It's nowhere close to what it was in the early days in the 70s and 80s. And it actually is a boon to the average investor.
But I think Ben's point is there must be a reason why suddenly SPACs have exploded so much. There is an advantage to the process for the people that are using the SPAC system. I think what Ben is expressing is some concern about that process. Are we going to be down the road 6 months from now saying, the SPAC boom has gone bust because so many SPACs came public that were, some would say, and Blankfein was implying, not necessarily ready to come to market? Is that a fair observation?
Again, I don't think it is by and large. I think as you and I discussed on Friday, of course, there will be people and management teams and sponsors drawn to this structure that shouldn't, and those will have bad outcomes. But is every IPO a good outcome? Not even close, despite the rigorous vetting, because at the end of the day, Wall Street gets paid to take companies public. So they're going to take companies public. It's like the old Doritos commercial, go ahead and eat them, we'll make more. And so at the end of the day, look at the companies that have gone public using the SPAC IPO. And you ask, Bob, what's changed? What changed really was Chamath and Virgin Galactic, where really robust companies of the future, these companies in electric vehicles, in video gaming and esports and e-commerce and space travel, these companies that if you had to have 5 years of profit, if you could only make commentary on historical revenues and cash flows, you wouldn't be able to do a roadshow and tell your story. What the SPAC structure allows is open-ended commentary about future story, and it gives these high-growth, great businesses a platform to, I think, bring what had been private businesses the opportunity to be invested in by the individual investor, which is fantastic.
Yeah. I want to talk to you more about that in the podcast, and Chamath and how it changed the business.